Hey, what's going on everyone? I'm Jonathan Wang and this is Motivational Money. We're going to talk about the one thing that everybody wants, money, in ways that shape out a mindset that can help get you to where you need to be. Now, in this episode, we'll be looking at new ways to scale everything we know today so that this experience pays dividends in the future. So, what does experience mean to you? With technology becoming more and more integrated into our daily lives, we become more and more distanced from the simple mechanics of how things work. As an example, cameras. I'm talking standalone cameras long before they were ever in phones. Before digital cameras were invented, Kodak, with their disposable cameras, was a household name. These were those handy dandy cameras that you wind up for a battery charge, point and shoot. You didn't get to see what you shot real time, so you took several shots just in case one was blurry or maybe somebody blinked. Back then, you had to take your film roll to the store to get developed, and that is where the hobbyist was born. You never forgot the first time you got your hands on an SLR camera. You would learn the mechanics in photography like shutter speed, aperture, and depth of field. That feeling of being in control of the images that you captured was incredibly empowering. Then digital cameras came out, which just beefed up SLRs to DSLRs, and that just made Kodak a name of the past. Now we have smartphones that you just point and shoot, and it suddenly does all the touch-ups on 4K resolution images that rival professional DSLRs to an untrained eye. If you ask a kid with a smartphone on what shutter speed or aperture settings they use, you probably hear crickets. The moral of the story is that there's a whole journey behind today's innovation that people nowadays may never get to experience. Technology has been a blessing and a curse. To the generations that came before us, they would say that with technology came the birth of ignorance and the death of curiosity. Each new generation becomes further and further removed from the basic mechanics of everyday life. They lose out on that opportunity to learn how and why things function the way they did. It wasn't just for hobbies, it was once in academic curriculums. Back in the day, auto shop was a standard class offered in high school. Students could learn how to take apart a car, diagnose a problem, and rebuild everything under the hood. This was once called good old-fashioned elbow grease, where you just rolled up your sleeves and you got her done. This is what financial statements are all about in investing. Your portfolio is your garage, and every company you buy is a vehicle you're adding to your collection. You don't want to buy a lemon, you want to buy a collectible that grows in value over time. Are you going to take somebody else's word for it that the car runs as clean as a whistle? Or are you going to pop the hood and see what you're working with? The difference between cars and finance is that in cars, technology has become so advanced with the sensors, onboard computers, and sophisticated powertrains that it's not that easy to service your own car anymore. But the mechanics of a company's financials will always be the same. So when you first look under the hood, it would help if you knew what you were looking for, right? You'd be very thorough to make sure there's no strange sounds or funny business going on. You would ask questions about mileage, maintenance history, and service records. In finance, you're doing the same thing by asking 4 things about a company's financials: growth, profitability, liquidity, and cash flows. These are timeless principles that companies will always strive for. Now, if you've already added things to your garage, then you should already know how they run. That means every now and then you're gonna do some routine maintenance checks just to make sure that each company is a well-oiled machine. Here are 3 common methods to analyze financials over time. The first method is period over period. This is where you measure 2 consecutive periods in time. Let's say we like to compare February with the month right before it, January. This would be called month over month. If we wanted to compare a company's second quarter versus its first quarter, this would be called quarter over quarter. Whether you're looking at sales, profits, or cash flows, this is the most basic method to determine if a company is improving or not. The one downside of this method is with seasonality. Think of companies in industries like retail, where Black Friday and Christmas are the largest selling holidays of the year. This means November and December, the fourth quarter of the year, is going to be phenomenal. Highest quarter of the year. But once you look at the next quarter, which is Q1 of the next year compared to that Q4, oh, it's going to look horrible. Period over period is a great way to see directional movement at a glance. But seasonality is something to be mindful of. The second method is comparative period. In short, comp period. This is where you compare one period of time with that same period from the year prior. This can also be referred to as year over year. If we wanted to see December comparative sales and we compare December sales with December from the year prior, now this is apples to apples, so no issue with seasonality or anything. If we're looking to see how the company's fourth quarter performed on a comparative year over year basis, we compare this fourth quarter with last year's fourth quarter. Comparative analysis is the most commonly used method by both a company's internal management as well as Wall Street analysts. This is a very precise measure of a company's performance relative to itself during that same time last year. The only caveat is that when this is used by itself, it's got blinders on for everything that happened in between those two periods in time. Nevertheless, this is a must-have in every investor's repertoire of metrics. The third method is most recent period over the average of all periods. Financial statements are prepared in two ways, by year and by quarter. When you look at the annual statements, each period is a full year, so there's no issue with seasonality or anything. When you look at one period versus another, most recent period over average is most commonly used on the quarterly financial statements. As the name implies, you take the most recent period and divide it by the average of the past 3, 4, or 5 periods, depending on what you deem as relevant. Let's say we use 5 periods. That way, the most recent period has a comparative period. This tells us how the most recent period performed relative to the average of the past 5 periods. If this number is a 1.0, the most recent period is in line with the average of the past 5. If this number is less than a 1, then the most recent period is underperforming relative to the average. Greater than 1, outperforming the average. The power of averages is the most effective way to draw a straight line in the sand and measure the most recent point in time against stability. This method accounts for comparative periods, so seasonality is not an issue. It also considers the periods in between, so there are no crazy blind spots or anything. Any crazy ups and downs in between are smoothed out with the average. The important thing to be mindful of is that a positive or negative number doesn't mean it's good or bad. For example, a company that continues to widen its losses would have a negative number in both the most recent period and in the average of all periods. A negative divided by a negative gives you a positive. In this scenario, that would not be good. On the flip side, if the most recent period is positive but the average of all periods is negative, that gives you a negative number on a good situation. Rule of thumb, if this method is applied to net income, it would never be an issue when you're looking at companies that just don't lose money. It also isn't an issue on revenues because the lowest revenues can be is 0. There's no negatives. Friends, these 3 methods of looking at financials are the fundamental tools to learn how and why public companies perform the way they do. The entire market is your auto shop. Every public company is going to report on financials every 3 months, so you'll have plenty of opportunities to sharpen your skills. Pop the hood, roll up your sleeves, and put some elbow grease into it. You have all the opportunity to add great vehicles into your collection, and your collection may outperform the best of the best one day. Imagine if you embraced all that technology has afforded. Show those around you that curiosity is not dead. It's just getting started. What this means for you is that after you've had the time to observe a company's market performance with their financial performance, you start to get a sense for what investment strategy you are most comfortable with. On the spectrum of investing, there are 4 fundamental strategies built on these 3 common methods. Until next time, I'm Jonathan Wang. Stay sharp. Stay safe, everyone.